Probably just like most of you, in the last 6 months, I've had more messages than ever from family and friends asking what stocks they should be buying. Well, in this video, we're going to go over the most high-level, simple entry point into the market for new investors. Oh, and by the way, this method gets better returns than 87% of professional investors. Now, before we get into that, for those of you that are new here, my name is Chris, and this channel is dedicated to all things investing, finance, and business. So if you're interested in learning more about growing a long-term successful portfolio, click that subscribe button and press the little notification bell next to it so you can stay up to date on all of the latest market announcements coming out of this channel. So now that we've got the formalities out of the road, we're going to be talking about the most effective way new investors can beat more than 87% of professional full-time investors with a little tool called low-cost index funds. In fact, Warren Buffett himself even recommends this method.
Consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin. Because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way.
So look, the once richest man in the world is essentially telling us that the average person is far better off buying into an index fund consistently, regardless of the price or market cycle that we're in, than they are trying to pick individual stocks. Which is kind of interesting considering him himself made all of his money doing the exact opposite of the advice he is giving us. However, I think by the end of this video, you'll probably understand as to why he is giving that advice to most people over sending them out to pick individual stocks and try and beat the market. And I think part of that comes from what I said at the start of this video, which is this method beats 87% of professional investors. And what do I mean by that? Like, it sounds crazy, like some big sales pitch to you. It's not really the case. It's actually more of a case that 87% of investors, professional investors, can't actually beat their underlying market index. That means, for example, if the top 500 companies in America return roughly 8% a year over 100 years, that 87% of fund managers can't return 8% or greater over the last 100 years. So this is more of a safe long-term bet that you are not part of that 13%. So what exactly are index funds? Well, technically to the end user like you and me, we would call them exchange-traded funds. And to keep things really simple, an exchange-traded fund usually represents an index. For example, in America, we have the S&P 500, which is an index that represents the largest 500 companies listed on the New York Stock Exchange. Now, you can't directly buy that index, but what companies like Vanguard and many others have allowed you to do is purchase an exchange-traded fund that holds each of those 500 companies. So essentially what Vanguard have done is saved you from having to go and buy and manage those 500 companies in your personal portfolio. Instead, they put them into a basket and they listed them on the stock exchange so you could then go and buy a piece of that basket whenever you felt like it. Now, of course, there are hundreds of indexes around the world covering all kinds of weird and wonderful asset classes. Of course, we have indexes covering property, currencies, commodities, bonds, and a lot more. In fact, recently there's talk of a lot of indexes being pointed towards cryptocurrencies, which will be very interesting. But for the most part, in this video, we're going to keep it simple and focus on exchange-traded funds that are surrounding the stock market and their respective indexes. So we've spoken about what an index fund is or an ETF is, but why are they so popular? Well, I think there's probably two reasons for that. Firstly, it makes it really easy for the everyday investor like you and me to obtain a market average return over a very long period of time. And the second is that it takes almost no effort from our part to log into our brokerage account once a month or so and purchase index funds and forget about them. Ultimately, you have to remember that this is a long-term game. Short-term, nobody knows what the market will do, including Warren Buffett. But you can guess that over the next 100 years, just like the last 100, on average, you'll obtain a 7 to 10% compounding return. And yes, I know that 7 to 10% doesn't seem like a lot when you compare it to some of the cryptocurrency returns lately, or even tech returns over the last couple of years in Australia or abroad. But you have to remember that 7 to 10% compounding over 30 years is an absolutely incredible thing. And I'm going to give you an example of that. Now, this website is an Australian website from Noel Whittaker. I have absolutely no association with him, but I have been using this calculator for a very long time, and I will leave a link in the description below for you guys to check out. So as an example here, let's say that the average person in Australia makes $80,000 a year. And after tax and your personal expenses, you might be able to save and invest $15,000 a year. So in this example, I'm going to assume you also have $15,000 in savings right now. So if you can actually maintain that amount over the next 10 years, you've got $15,000 as a lump sum invested in the beginning, and you've invested $15,000 a year over a 10-year period with an average return of 8.5%, your return would actually be around $256,000. And yes, that is great, because even if you compare that to what it would be in a cash account, if there was no interest, it's considerably more. Where the magic really happens is with compounding interest over a longer period of time. So at the 20-year mark, things get very interesting, because in only double the amount of time, you've almost got 4 times the results, coming in at just over $800,000. But I will say it once more, because time is everything when it comes to compounding interest. So when we go further down here to the 30-year column, you will see that if you maintained your original investment of $15,000 and continued to contribute $15,000 per year over 30 years and never sold anything, you'd have just over $2 million. And I mean, for most people, that's absolutely life-changing money. And that all came from $300 a week, which could make anybody a multimillionaire in 30 years. Just imagine starting from 18 years old. By 48, you'd be in a position of complete financial freedom. And yes, for those wondering, if we scroll down to the 40-year mark, that would be $4.8 million if you hadn't touched it the whole time, which is absolutely incredible. Anyway, I think you guys get the point by now. Index funds can be a very astute path to financial freedom. But then the next question I always hear is, well, what index funds should I buy? Although I can't give you financial advice here, obviously, we can look at some of the facts which might point us in the right direction. Firstly, according to Warren Buffett, the S&P 500 is the way to go. However, the general concept Buffett is advocating for can be replaced with almost any large cap index fund, pending that you believe the underlying index is a sustainable source of growth over a long period of time. So what do I mean by that? Well, essentially, you have to believe that the underlying country's GDP will continue to grow as a whole over a long period of time. For example, we would assume that Australia will continue to grow at a reasonable rate over the next 50 years. So I'm personally comfortable in investing in Australian-based large cap index funds. And the reason for that really is because if I think Australia is going to grow, the companies inside of these index funds now are kind of irrelevant, because they will keep cycling in and out. New companies will come up, older companies will go out. All that matters is that there is a net gain over a long period of time as to the profits and the revenue that those companies are creating. So here are 4 low-cost index funds that you might like to research and consider adding to your portfolio. The first is the Vanguard 500 Index Fund, which runs under the code on the New York Stock Exchange VOO. This is literally the fund Buffett is referencing in the video I shared earlier. A low-cost, exchange-traded fund representing the biggest and brightest companies in the United States. Now, regardless of any short-term hurdles that we might have going on in America right now, I do find it hard to believe that they won't be leading the way when it comes to innovation and commerce for the next half century. And I'm not saying that others might not take the top spot off them in the next 50 years. I'm just saying that they are still going to be a leader of that pack for a very long period of time, at least in my opinion anyway. And of course, we can't use this as an exact indicator, but it does give us a bit of an idea on historical returns for a fund like this. So for example, if you would have invested $10,000 in 1971 in the S&P 500 and not taken a cent out until today, you would have just over $1 million. And the great part about that, and why Warren Buffett likes to include the low cost words in his low cost index fund spiel, is that you only pay 0.03% management fee. That means for every $10,000 you invest, you'll only pay $30 a year in management fees. So, I mean, this really is the bar when it comes to low-cost ETFs, regardless of your geographical location. Now, the next fund we're talking about is the Invesco Qq, which runs under the code on the New York Stock Exchange, QQQ, believe it or not. Now, this fund is a little more specific than some of the larger funds like the S&P 500. However, possibly a factory for above average returns over the next 50 years. And you might be asking, well, why? Why do I think that? And the reason becomes obvious when you look at some of the companies that are inside of this fund. Now, this fund tracks the top 100 companies listed on the NASDAQ, which is home to companies like Apple, Amazon, Google, Facebook, and many other famous names that you've heard of from America. Now, just a heads up, this fund has run very hard over the last few years, especially in the last 10 months or so. And although I'm an advocate for dollar cost averaging, this might be one to watch if it's your first time entering, and try and better understand it before you dive headfirst in with a large amount of your capital. And the reason for that does come down to your personal liquidity and how much money you have on the sideline already. Let's say that you got $50,000 and you put $50,000 in QQQ today, and then QQQ crashes down 50% over the next 2 months. Well, I'm not saying that it will never return to those highs. In fact, it's very likely that QQQ could be double or triple what it is over the next 50 or 100 years. However, you might be in a position where that $50,000 is now worth $20,000 or $25,000, and you might not have enough cash lying around to sustain your personal lifestyle. Well, the last thing you want to go and do is pull out of that fund at a 50 or 60% discount just to sustain your lifestyle. So that's why I give that warning. It's not that I think that this is the all-time high permanently. It's that you don't want to be in a position short-term where you're forced to pull some money out that is in a optimal position. But anyway, like I said, this fund is dominated by some of the largest technology-related companies in the world, and between you and me, I just don't see these guys getting any smaller over the next 20 or 30 years. And I did make a video a little while ago on my channel, and I can't quite think of the name right now, but I will try and link it above if I can find it while I'm editing this video. And pretty much what I was talking about in that video was how much technology is really going to affect our lives over the next 50 years, and in my opinion, especially the next 5 to 15 years. And I think we all look at technology and think of the amazing things that are happening right now, including the ability for me to make this video and post it to all of you. But the real changes, in my opinion, come when it affects our actual day-to-day lives in a meaningful way, not just in a way that we can pick up our phone and communicate with somebody, but in a way that you might not have to clean your home anymore because there's some type of automated device doing that for you as a whole. You might not have to prepare your own food anymore because your kitchen is an automated process, essentially a home restaurant. You might not have to drive yourself anywhere anymore or use Ubers or taxis because your car can take you, drop you, and then come and pick you up later. And that's really just the tip of the iceberg. There are so many other areas, especially when it comes to home security and things like that, that are going to completely change in the next 5 or 15 years, in my opinion anyway. And that is why I'm so bullish on these funds long term, because even if it's not the companies, and it's highly likely that it is these companies that are going to be creating these products and implementing them to us, but even if it isn't these companies that are creating those products, any of the companies coming through that are going to be listed in this space will end up being in this fund anyway, so it will benefit you long term regardless of if it's Google or company X in 10 years. However, you do need to keep in mind short term that if there were to be a correction or a crash, the Nasdaq usually declines more than other markets like the S&P 500. And it's not significant. It's not like the Nasdaq drops 90 because the S&P drops 40. But there is usually more that comes off the top because these companies accelerated more before the market crashed. So that is something to keep in mind, especially if you're entering from a brand new position. I mean, if you started entering 5 years ago, depending on your strategy, it probably wouldn't make sense to stop dollar cost averaging because you're playing that long-term game already. But if you are jumping in now, it is definitely something you want to discuss with a professional before you just dive headfirst in and potentially risk capital and many years of your life. Now, before I move on from QQQ, it is worth keeping in mind that the management fee is slightly higher than what I would class as a traditional low-cost fund. And when I say that, it's something crazy, but it is at the higher end of low cost. So the management fee comes in at 0.2% or $200 per $1,000 invested in yearly fees. And yes, it isn't ideal, but it's not something that I personally would worry about when investing in this fund. And the main reason for that is, generally speaking, you probably will make up the difference with an aggressive fund like this as it grows over the years. If that was up towards 0.5% or 1%, I would be more worried, and it wouldn't be something I'd have to look for an alternative option. But in this situation, it's not really something that I'm worried about for me personally. But it is going to be up to you to make your own decision on if you want to pay $200 per year per $10,000 invested in fees. Now, the last fund we're going to talk about is a local fund here in Australia called the Vanguard Australian Shares Index ETF, or VAS. Now, this fund is tracking the largest 300 companies listed on the ASX. So let's start off with what I like about VAS. Well, firstly, the consistency it can provide for new investors and retirees alike is pretty decent, paying a consistent income or distribution of 4 to 5% annually, along with some capital gains. So, for example, since inception, I believe it's returned about 6.8% annually, which is not to be snarled at. Now, another benefit to a fund like this would be its incredibly low management cost. Most Aussies are paying 1% plus costs in their fees via superannuation. And like I mentioned earlier, that's not the case across the board anymore necessarily. There are some companies really taking the lead and bringing those management fees down, which is great. But there are still companies out there charging 1% plus costs. And if you compound that over 30 or 40 years, you will see a massive difference in how much return your fund is getting. And a way to do that is by going back into that calculator I mentioned earlier in the video and taking $10,000, it can really be any amount, but say $10,000 and no yearly investment. Put 7% return in and see what that amount is in 30 years. And I'll try and put the result of that up here on the screen. And then you're going to take that 7% and make it 6%. And have a $10,000 investment and see what that result would be in 30 years. And now, like those superannuation ads that we used to see on TV comparing the results, that is the difference. And I don't even know what these two numbers are right now, but I know they are significantly different because this is how much of a difference fees makes in your portfolio. However, there are some downsides to purchasing a fund like this. And I think the first one would be that if you're younger here in Australia, the top 300 stocks are generally speaking dividend heavy, and this can have an impact on capital gains and the tax that you pay. So, for example, if you're, let's say, 30 years old and you're making $80,000, if you happen to have a large portfolio in VAS, that might increase your taxable income by quite a bit, and it might push you up to that next tax bracket, which means you're actually going to be paying more tax than you want to across the board. Because something you have to remember, and I see this all the time online, is that a dividend is income. Just because you're reinvesting that dividend into VAS doesn't mean that it didn't happen. That is still income, and then you've chosen to reinvest it even if that process is automated. So you do have to pay income tax on that dividend that's distributed to you every single month or quarter or whatever it pays out to you. So perhaps a fund like this might not be suited to a younger or more aggressive type of investor. And it really does depend on how you've structured your portfolio. If you're inside of a corporation, a trust, or a superannuation account, then these aren't going to be massive concerns for you necessarily. But if it's a personal portfolio, it's something you're definitely going to have to think about depending on your tax brackets. And this is really something you want to sit down with your accountant and go through in a lot of depth. Go in there with 100 questions and ask each and every one of them and try and clear that up, because sometimes it is better changing your structure. And even if it costs you some money short term, then it is sticking with that and paying all of this tax over 30 years that could have ended up going back into that fund and compounding even more. So like I said, there are hundreds of exchange traded funds. I will try and link as many as I can below in the description to international funds that you maybe haven't heard of before. I will also link you to what I believe is probably the best single collection of index fund information in Australia here for investors. It's at marketindex.com.au. They've got some really great content on that website. They've recently upgraded the site, put a bunch more stuff on there, and I think it's a great source to just get some fundamental information on different funds and stocks. So I will leave all of that below. Now, of course, please don't forget to smash that like button. I have been away for a while here, so it does help me in taming the beast that is the YouTube algorithm. And of course, if you haven't already and you did enjoy this content and want to see more, feel free to tap that subscribe button and press the notification bell so you're notified when I release new videos. But that does bring me to the end of this video. Thanks again for watching. I appreciate your time, and I'll catch you in the next episode. Cheers.